Hello, today is July 10th, 2022. I'm Jason Shapiro from Crowded Market Report. This is our first video of what will hopefully be a weekly addition to our webpage. And what I thought I would do, since this is the first video, is really sort of take you through how I approach trades and how I approach portfolio management, to hopefully put risk reward on my side over time, and the discipline of it all and all that. So the best way I think to do this is just go through trades that I have on currently and trades that I've put on in the last week, and talk a little bit about why and how the portfolio looks. So I came into this week long the Russell and long the Dow. The Russell trade was put on June 23rd. So the first screen that I always use is the Commitment of Traders reports. I'm looking for speculators to be very short, because I think that means they have discounted in, obviously, a lot of bad things if they're very short. So the risk reward can get skewed to my side. And again, the risk reward can get skewed to my side. It doesn't mean that this works every time. I can assure you it doesn't work every time, which is where risk management comes in. And I'll talk about the risk management process of it all. But when the COT is skewed like this is, you can see this Russell, how skewed it is. And this was back when I put the trade on over here, but it's even more skewed now. But this is the Russell. So I'm like, okay, speculators are very short. I'm looking to get long. I'm looking for a sort of a news failure type reversal day. And by news failure, we're looking for like, okay, speculators are short. Why are they short? Well, what's kind of the fundamental mantra that people are looking at these days? And if we get news that supports that bearish mantra and the market can't go down anymore, then I'm looking to be long. And that's what happened on June 23rd. We had some bad news. The market did go down. It reversed and it closed on its highs. So I get long on the close of that day, and my stop is at the low of that day. I'm picking a turn in the market. See, this is the thing for me, and it doesn't mean it has to be for you, but for me, I'm picking a turn in the market. And what that gives me is, if the market goes through the low, well, then by definition, I didn't get the turn. So by definition, I should be out. So I have a very defined stop there on the trade, right? That makes sense. It's very easy for me to stop out of a trade when something hits a new low. I don't have to question it. I don't have to worry about, oh, should I stop, should I not? It's on a new low. I didn't get the turn, stop out. So now I have a defined stop. I have an entry. So I know the difference between my entry and my stop. So I know how much I'm going to lose on the trade. I then figure out, okay, if I'm going to lose whatever it is, 20 Russell points, let's say, then what percentage of that is my portfolio, and what percentage am I comfortable? So traditionally, what I do is about 70 basis points per trade, because I know over time, of having back tested and everything, that will provide a vol to my portfolio over time of about 8, which is the targeted vol that I'm going for. So I put on enough Russells that I will lose 70 basis points if it takes out the low and I get stopped. So there's the Russell trade. Okay, so now I'm long Russell. Then I got long Dow on July 1st. The Dow COT looked like this. And this was July 1st right here, by the way. But you can see that specs were super short. And same thing, we had some bad news. The market reversed, the Dow closed up. Now I'm long Dow. So now I have to say to myself, hey, okay, I've got two trades on, long Dow, long Russell. Aren't these basically the same trade? They're both long the stock indices. There's high correlation there. So do I want to have a full size on both of them? Because now I'm really not risking 75 basis points. Essentially, I'm risking 150 basis points on the same idea. It's not 100% the same idea. The Russell can outperform sometimes, the Dow can outperform, whatever. But essentially, it's the same idea. So what I do at that point, since I only have these two trades on, is I will shrink size on both. In this particular instance, I shrunk both the sizes, what they would be, in half, which is more than usual. Okay, half. Now I've got it back to 75 basis points, but the truth is, usually if I get two trades that are so correlated like this, it's a much stronger signal. I won't really shrink it to half. But in this particular case, there were so many other cross currents in the market that I wasn't really totally comfortable, and this becomes more discretionary than anything else. So I shrunk it a little bit more than I usually would, and I kind of put, half size for both trades on. So now I come into this week. I'm long Dow, I'm long Russell. And what's set up that I could possibly get long coming into the week? Well, silver, copper, crude, and gold all were set up to be long. I had nothing to be set up to be short. All were set up to be long. So what happened? On Wednesday, we had a situation where, and as this last week went on, it became clear that what was dominating the markets was the idea of the dollar. The euro started to collapse, the dollar making new highs. Everybody started talking about, euro hitting, 1-to-1 with the dollar, and it really became the focus of what was going on in the markets this week. So I'm thinking, okay, the contrarian trade here is to be short dollar. However, I don't really have anything set up in the currencies where I can get long. You can see these currencies. Okay, the dollar index, sure, the specs are long. I don't trade dollar index. But the Aussie, there's nothing special there. Nothing special. British pound, okay, they're a little short, but I like it to be down here, right? I like it to be at max. Canadian, euro, even, there's nothing really that special. So how am I going to get short dollar? Well, what is set up on the COT is gold and silver, okay? And I get a lot of questions on this, but like silver, for example. So these are the specs, right? I'm looking for them to be super short. Well, in the metals, specs never get super short because commercials never get super long because commercials are essentially hedging their production. So they're always short or almost always short. But if you look at where the specs are relative to where they usually are, this is the least long that they've been in a long time. So on an index, as I index this data, it's showing that specs are short silver, which is really, they're just very, very not long silver. So lo and behold, on Wednesday, we had a day where the dollar rallied strongly. Risk assets were getting hit. And metals were getting hit. And silver, for whatever reason, closed up, and it should have been a down day. So there it is. There's kind of a news failure, which can also be like a correlation failure. Everything that silver is correlated to is down a lot. Silver closed up on the day. So there's my failure. I get long silver on the Wednesday close. And again, I stop out on the low of that day. Silver did go down and make a new low that day, closed up on the day. I'm stopping out on that new low. I can size my position, right? But now I have to consider, okay, I'm long Russell, I'm long Dow, I'm also getting long silver. Are these correlated? And if so, how am I going to deal with that on a portfolio basis, right? And this can be tough because this is a discretionary call. A lot of times, yes, you can run the correlations, but correlations are not very stable. But because I wanted to have a sort of short dollar position on, right? And this is the short dollar position, I will put a full position on. However, we had the same thing happen in copper on the same day, right? Here the specs are super short copper, right? This is also arguably a dollar trade. Weaker dollar, stronger commodities. So if dollar is going to get weaker, commodities will most likely get stronger. Again, no guarantee, but that's kind of how it feels to me. So I'm getting long copper. So again, I'm long copper and silver. Probably similar trade, probably similar situation. So again, I just put a half a size of each one on instead of the full size. So now I'm risking 35 basis points for each one of these trades from entry to stop. So now I'm long as of Wednesday, long Russell, long Dow, long copper, long silver, right? Then we get to Thursday and crude oil, same type of thing, right? If you look at Brent, you're seeing specs very short. If you look at US crude, you're seeing specs the least long, again, that they've been in a very long time. There was an inventory report on Thursday on crude. It was much more negative than people expected. Crude finished almost on the high of the day. I'm buying crude on the close on Thursday. Again, I'm stopping out on the low. And look, I already have long silver, I have a long copper, I've got long commodity trades on. I don't know that crude is necessarily that correlated to that, But again, I'm half sizing this because I already have this exposure. So I've got now long Dow, long Russell, long silver, long copper, and long crude oil. So I'm basically long stocks and long commodities. And then Friday comes and we have the same situation. Friday was a great situation for this type of stuff because you had an employment report that was much stronger than expected, okay? And this gets into the idea of, okay, now the Fed is not going to hold back on raising rates, which is where we are in the market right now, right? So if the Fed is not going to hold back on raising rates, then the dollar should be stronger, which means metals should be weaker, et cetera, and possibly stocks should be down. But what we had was stocks finished flat to up on Friday. The dollar, after being up after the employment number, actually finished down on the day. So there's a straight up news failure in dollar. And you also had gold finish up on the day. Okay, and gold clearly has always been sort of the anti-dollar trade, right? And gold, same thing. The specs never really get short gold because commercials never really get long gold. I'm not going to say never, but it's very, very rare. But again, you're looking historically, this is the least long people have been gold. Speculators have been gold in a long time. Gold closes up on Friday, I get long gold. Now again, I'm already long silver. I'm already long copper. So what I did was I put the gold on and I shrunk my copper and silver down. So rather than have a half of a regular position on those three trades, I now got about 35% of a regular position on those three trades, right? Gold, silver, copper. I'm also long stocks, Russell and Dow. So my question becomes, okay, and this is where it gets real confusing, but I'm long stocks, I'm long commodities. How is that going to work given the mantra of what's going on in the market right now, right? If things are going to implode the whole recession story, that's probably going to be bad for stocks and probably going to be bad for commodities, and I'm probably going to be in trouble on those trades, right? Although you can make the counter argument. If the numbers come out weak, then the Fed doesn't have to raise as much, and if the Fed's not going to raise as much, then maybe stocks and commodities can go up. I don't know which one it's going to be. There's no, these things you can kill yourself over forever. What I do know is I am fading crowded trades where the market tone is starting to become positive for those trades, right? I'm shrinking size because of the correlations across the trades. And then the one last thing I can do, I like to think of the downside. If the upside happens, it takes care of itself and everything's great. It's the downside that I have to manage money against, right? Because as I kind of like to say, and some other people I know like to say, the real name of this game is to stick around long enough until you get lucky, right? Put on enough trades where everybody's crowded on one side and you're going the other way. Put on enough of those, and over time you will catch some very big trades. But if you blow out before that happens, you know, you're not going to be there. All right. So what can I do worrying about the first thing I said? Let's say that the economy, you know, we got CPI coming out this week. Let's say CPI becomes much lower than expected. All right. Or let's say it becomes much higher than expected. You know what I mean? Like stocks and commodities could go down. So what am I going to do about that? Well, most of the time I won't do much. And this is my process, and I'll just go with my process and sort of manage the sizing and the correlation so that I don't have too bad of a problem if things go wrong. But in this particular case, we see that specs are actually quite long in NASDAQ here, even though they're short every other stock industry. They're quite long in NASDAQ. So what I will do to hedge that idea of all the assets going down is, should the NASDAQ start underperforming during the day, and this is a sort of a short-term trading thing that we do talk about on our webpage quite a bit, on our Discord page, but just suffice it to say, when the NASDAQ starts to underperform, I will start shorting NASDAQ as a hedge to this long Dow, long Russell, long commodity trade, which will help again on the downside, right? And this is only when, again, there has to be market confirmation. In any trade I do, there has to be market confirmation. It's not like, oh, this is what I think, so I'm going to put it on. And it's not even like, oh, this is what the COT is showing, so I'm going to put it on. That is not enough. And if you do that, you're going to get destroyed, right? You can run a system where you just blindly buy this stuff where everybody's short in COT and blindly sell this stuff that everybody's long in COT, and you'll see you'll get run over. You need market confirmation, not just for these type of trades. In my view, for any trade that you want to put on, the market has to confirm what you're thinking, because you can be wrong, right? The market's not wrong. So when there's confirmation in this situation of the NASDAQ starting to underperform, I will short the NASDAQ to kind of hedge out these other, let's call them risk on trades in my portfolio. So I hope that all kind of makes sense. I want to reiterate, this is how I trade. This doesn't necessarily have to be how you trade, but I think the concepts of where are you stopping out and why, right? Saying, oh, I get long S&Ps and I'm stopping out with a 10-point stop loss. Okay, but if the S&P is moving around 40 points a day like it is these days, you're going to get stopped out 10 points. You could be totally right, and you could just get stopped out just on a random move, right? So have a stop that makes sense based on your trading goal or your trading style or what it is you're trying to capture, right? Have a stop that makes sense and don't violate your stops, right? And then again, you have to look at obviously the risk, not only of your individual trades, but of your whole portfolio, which is a lot harder to do. You can do it mathematically, run value at risk and all that type of stuff, but correlations are so unstable that I just kind of, for me, I watch, and I pay attention to what the markets are kind of thinking and how they're acting because of that thinking, and therefore where can I hedge that out and where do I need to shrink position size because there's too much correlation in my market. So, these concepts go across any style of trading you have, right? So that's kind of how my stuff is looking that week, and this is kind of how I do it. And what I was trying to say was just because this is how I do things, it doesn't mean it has to be how you do things, and I wouldn't even suggest that it should be. People should understand that I run portfolios for institutional clients who, at the end of the day, allocate money to me because of what I do offers a very negatively, zero, I would say, to negatively correlated return stream to most of the things they have in their portfolio. And just like me, when they're putting a portfolio together, what they should be doing is putting a bunch of return streams together that are not correlated. The way to get rich is put a bunch of return streams together, all with positive return expectations and non-correlation across them. Put those on, go to sleep for 25 years, and you're a billionaire. It's exactly what Ray Dalio did, by the way, despite what he might talk about macro this and micro that. It's just a bunch of non-correlated return streams with positive return expectations. Put them on, let them go. So I am one non-correlated return stream to my clients. That's a process, or that's something that I offer them. That's theoretically my product that I offer to them. It's hard to find negatively correlated return streams. I offer that because of what I do. I'm fading the masses, so by definition, I'm going to be negatively correlated to what else they have. And because I have good risk management, I won't blow out. So when everybody's making money, I'll lose a little bit. When everybody's losing money, I'll make a lot. And then sometimes they'll make and I'll make some too. And sometimes they'll lose and I'll lose a little bit too. But what I'm trying to say is that's what I do, and that's the product I offer. That might not be what you're looking to do. Yes, I have positive returns. Yes, I have good return over risk. Yes, my Sharpe is pretty high. Yes, my return to drawdown is pretty high, and that's all great. But most people are looking to maximize their profit, obviously, on their trading. And this may or may not do that for you. This might be a part of doing that for you. But regardless of if you do these type of trades or you do other type of trades, how you like to trade, the concepts of stops, why the stop is there, what your portfolio looks like, what's the risk across the portfolio, making sure you don't blow out over time. So these concepts cut across whatever you're doing out there and are much more important than how you're deciding to buy or sell something. I mean, flip a coin, you know, to buy or sell. Use good risk management and you're going to be way better off. So that's kind of what I wanted to talk about this week. You can check us out on crowdedmarketreport.com. I'd be more than happy, and I would actually request that if you are watching this video and if you want to see me speak about other things in other videos, please make a request. I'd love to hear what you'd love to hear, what you'd like to hear me talk about, and I will try to make videos that talk about those things. Okay, thanks.